In 2019, a behavioral economist named Sarah Stanley Fallaw published a study. She spent 3 years surveying over 600 millionaires across the United States. Not celebrities, not tech founders, not lottery winners. Ordinary millionaires. The kind who live in normal houses in normal neighborhoods and drive cars that are 4 years old. She asked them everything: what they spent, what they saved, what they believed about money, how they thought, what they did for work. And when she finished compiling the data, she sat back and realized something deeply unsettling. The pattern she found had almost nothing to do with income. Let that sink in for a second. She had just spent 3 years talking to hundreds of people worth over $1 million, and the thing that actually made them wealthy was not how much money they earned. That is either very encouraging or very inconvenient depending on how you currently think about money. We are going to spend the next 15 minutes going through what she found and what dozens of other researchers, economists, and wealth analysts have found when they looked at the same question. Because here is the uncomfortable truth this data keeps pointing toward. Most people are trying to get rich the wrong way. Not because they lack discipline or intelligence, but because the mental model they are operating from is just incorrect. And the system, it turns out, quietly rewards that confusion. Let us start with the picture most people have of a millionaire. You probably imagine someone in a corner office, a bonus check, a stock option that vested, a startup that got acquired, maybe an inheritance, a salary with enough zeros that the math just works itself out. That picture is not crazy, it's just incomplete in a way that quietly sabotages how most people approach building wealth. Here are the actual numbers. According to the Federal Reserve's Survey of Consumer Finances, which is the most comprehensive wealth survey conducted in the United States, roughly 22 million households in America have a net worth of $1 million or more. That sounds like a lot until you realize it's about 17% of all American households. And when researchers start breaking down how those people got there, a few things immediately break the popular narrative. First, inheritance is massively overrepresented in how we talk about wealth, and massively underrepresented in how wealth is actually built. Studies consistently show that less than 20% of millionaires received significant inherited wealth. The number varies study to study, but it is never the majority. Second, income is a surprisingly weak predictor of net worth. The Federal Reserve's data shows households earning over $200,000 a year who are essentially broke on paper, and it shows households earning $80,000 a year who have crossed the $1 million threshold. How is that possible? That question is where this gets interesting. To understand the pattern, you have to understand a concept called the wealth gap. Not the gap between the rich and the poor, a more personal version of it. The gap between what someone earns and what someone keeps. Economists call it the savings rate, but that term is boring and clinical and makes people change the channel. So let's just call it the gap. The gap is the single most powerful variable in the data. More powerful than income, more powerful than investment returns, more powerful than the specific assets someone holds. Here's why. Imagine two people. Call them Person A and Person B. They both earn $100,000 a year. They're 30 years old. Person A spends $90,000 of it. They live in a nice apartment, they drive a car that costs $700 a month, they take 2 vacations a year. They feel wealthy because their lifestyle feels wealthy. Person B spends $70,000 of it. They live in a decent apartment, they drive a 4-year-old car they bought outright, they take 1 vacation. They feel slightly behind their peers. At the end of year 1, Person A has $10,000 saved. Person B has $30,000 saved. That's 3 times the gap from the same income already. Now extend that out 20 years. Give both of them a modest 7% annual return, which is roughly the historical average of a broad stock market index. Person A, saving $10,000 a year for 20 years at 7%, ends up with about $410,000. Person B, saving $30,000 a year for the same period at the same return, ends up with approximately $1.23 million. Same income, same market, same number of years. 3 times the outcome. Person B is a millionaire, person A is not. And here is where the discomfort comes in, because person A spent those 20 years feeling richer. Fallaw's research digs into this in a way that is almost embarrassing to read. She found that the #1 predictor of wealth accumulation was not income, not education level, not even investment knowledge. It was something she called frugality, the willingness to live well below what your income would allow. The millionaires in her sample were almost universally people who resisted what she called economic outpatient care. They didn't upgrade their lifestyle every time their income went up. That concept has a name in behavioral economics. It's called lifestyle inflation, and it's the mechanism by which most middle-income earners quietly fail to build wealth over a working lifetime. You get a raise, you get a nicer car. Your bonus comes in, you move to a bigger apartment. Your career advances. Your spending advances with it dollar for dollar, sometimes more. The gap never widens. Sometimes it narrows. And the really insidious part is that this is not irrational behavior. It's completely rational given the social signals people are responding to. Status is visible. Savings accounts are invisible. Nobody sees your index fund at a dinner party. They see your car in the parking lot. The millionaires in these studies had found a way to opt out of that game, or they had never bought into it in the first place. But here's the thing the data doesn't fully explain. How? How do you opt out of a game that the entire consumer economy is designed to pull you into?
In 2009, a pair of behavioral economists named Shlomo Benartzi and Richard Thaler ran an experiment. They were working with a manufacturing company whose employees were chronically under-saving for retirement. The employees knew they should be saving more, they wanted to save more, but every time they sat down to actually adjust their contributions, they found a reason not to. The rent was high, the car needed work, the kids had expenses, there was always something. So Benartzi and Thaler tried something unusual. They did not ask the employees to save more now, they asked them to commit to saving more in the future. Specifically, every time they got a raise, a portion of that raise would automatically go towards savings before the employees ever saw it. The results were remarkable. Within a few years, average savings rates at the company had nearly tripled. Not because anyone had earned more money, not because anyone had suddenly discovered willpower, but because the decision had been removed from the moment of temptation. They called it Save More Tomorrow. It later became the intellectual backbone of automatic enrollment in 401k plans, which is now standard practice at most major employers. The point is not that automation is a magic trick. The point is that the gap between knowing and doing is enormous, and the millionaires in the wealth studies had, in various ways, bridged that gap, not through discipline, but through structure. They automated savings. They bought homes in neighborhoods slightly below what they could afford. They drove cars that were functional but unimpressive. They made the spending decision once and then never had to make it again. Discipline is not a strategy. Structure is a strategy. Discipline runs out. Structure does not. Now here is where a lot of these conversations go wrong. People hear the word millionaire and they immediately start thinking about stocks, real estate, crypto, private equity, options trading, angel investing, the exciting stuff. The moves that feel like they could change everything in a short period of time. And yes, investment returns matter. Obviously they matter. But the data keeps pointing to something that Wall Street has very little financial incentive to tell you. For the vast majority of the millionaires in these studies, the investment strategy was staggeringly boring. Index funds, tax-advantaged retirement accounts, real estate held for decades, not traded, not flipped, not leveraged aggressively, just held. J.P. Morgan runs an annual analysis of investor behavior versus market returns, and almost every year it finds the same thing. The average investor underperforms the market not because they pick bad stocks, but because they trade too often. They move in when things are going up and move out when things are going down. They do the exact opposite of what the math requires. The S&P 500 has returned roughly 10% annually on average over the last century. But the average individual investor has captured only a fraction of that return because they kept interfering. The wealth researchers call this the behavior gap. You can have the right investment and still get the wrong outcome because you could not leave it alone. The millionaires in these studies were, in large part, phenomenally boring investors. They picked a simple strategy, automated the contributions, and then got out of their own way. That is not exciting content. It does not make for great television, but it is what the data says. Let us be honest about the other side of this. The financial media does not make money by telling you to open a Vanguard account and check it once a year. The brokerage industry does not profit from patient, low-turnover investors. The real estate influencer is not building an audience by recommending you buy one modest property and hold it for 30 years. The entire attention economy of personal finance is built around complexity, urgency, and the implied promise that there's a smarter move available to you right now. And that creates a strange distortion. The strategies that get the most airtime, day trading, options, highly leveraged real estate, crypto arbitrage, pre-IPO investing, are the strategies that have the highest variance. Some people win, some people lose badly. The stories from the winners get amplified. The losses are quiet. Meanwhile, the strategy that appears in the actual wealth data over and over again, save aggressively, invest consistently in boring, diversified assets, hold for decades, is so uncinematic that nobody builds a YouTube channel around it. There's a term for this in statistics. It's called survivorship bias. You only hear from the people who took the aggressive swing and connected. The ones who swung and missed are not invited to the podcast. The millionaire next door is rarely the most interesting person in the room.
Here is the part that is genuinely uncomfortable to sit with. Everything said so far could be read as implying that income does not matter, that anyone can become a millionaire if they just save enough and stay disciplined. That is not what the data says, and it would be dishonest to frame it that way. Income is a real constraint. Saving 30% of $40,000 a year is $12,000. Saving 30% of $120,000 a year is $36,000. Same rate, very different trajectory. The math is not indifferent to where you start, and the distribution of income in the United States has shifted significantly over the last 40 years. Wage growth for median earners has been remarkably flat when adjusted for inflation. The cost of housing, healthcare, and education has risen dramatically faster than wages in most markets. These are structural realities that make the savings game much harder for people in certain income brackets. The pattern in the data is real, but it operates within a context, and that context is not equally favorable to everyone. What the research actually shows is more nuanced than the self-help version suggests. Among people who have similar incomes, the behavioral variables, savings rate, investment consistency, lifestyle inflation, explain a very large portion of the wealth difference between them. But income itself is also a significant variable that compounds over time. The uncomfortable conclusion is that both things are true simultaneously. Behavior matters enormously, and structural inequality is also real. And a certain type of financial content tends to emphasize one in order to dismiss the other. Zoom out for a moment. What does it mean that we are in a period where 17% of American households have crossed the $1 million threshold, and yet surveys consistently show that most Americans feel financially insecure? A few things are happening at once. First, $1 million is not what it used to be. In 1980, $1 million net worth placed you solidly in the top 2%. Today, with inflation and asset price appreciation, it is a meaningful but not extraordinary position. The threshold keeps moving. Second, most of the wealth at the top is not in savings accounts or even broad index funds. It is in assets, businesses, real estate, equity stakes. Assets that generate returns, that appreciate, that compound. The wealthy do not just save money, they own things. There's a difference. Third, and this is perhaps the most quietly significant point, the time it takes to accumulate $1 million through patient, consistent saving and investing is typically 20 to 30 years. That is a long time in a culture that is increasingly oriented around immediate results. The pattern across 1,000 millionaires is not a secret. It is not proprietary information that was hidden from the rest of the population. The data is public, the books are available, the math is not complicated. And yet the strategy is rare, because the strategy requires something that is genuinely difficult in the current environment. Not intelligence, not access, time and patience, and the willingness to look less impressive in the short term than your income might allow. That turns out to be harder than it sounds. So here's where we land. The pattern is real. Across different researchers, different data sets, different time periods, the same variables keep appearing. The gap between income and spending, the consistency of investment behavior, the resistance to lifestyle inflation, the willingness to hold boring assets for a long time. None of it is exciting. Most of it is in fact actively anticlimactic. But here's the question that the data quietly raises and never quite answers. If the pattern is this consistent and this well documented and this available to anyone who wants to find it, then why does less than 1 in 5 American households actually cross the threshold? Some of it is structural, incomes that make the math genuinely difficult, costs that consume the gap before it can widen, systems that are not neutral. Some of it is behavioral, the gap between knowing what to do and actually doing it. But some of it, maybe more than we want to admit, is that we are surrounded by an economy that profits from our confusion, that makes complexity feel like sophistication, that makes patience feel like passivity, that makes boring look like losing. And the millionaires in these studies, the quiet ones, the unflashy ones, the ones living in normal houses, driving unremarkable cars, they had figured out something that is genuinely hard to internalize from the outside. The game is not about looking wealthy. The game is about actually becoming it. And those two things, it turns out, pull in almost exactly opposite directions.